on Sky News Business. This is Trading Day, the close.
A true coast-to-coast show for you today with guest hosts in the west and here with me on the eastern seaboard. So lots to look forward to, different perspectives on a day, of course, dominated by conjecture and then confirmation over a rates decision. The market, though, wasn't going to be pivoting higher on that alone. Indeed, it was dragged lower pretty much from the get-go, a softer lead from the street. We underperformed significantly, though, v that US finish with about a 1.6% sell down as we go into match out. Materials, energy bearing the brunt of it. Banks, though, of course, again back in a selling spiral, which is only just underscoring the volatility in this space. One session is up, then goodbye to all that today. Here we have Mark Todd from the NAB in Perth for you, as promised, and Pete McGuire from XM Group is with me in studio. So, gentlemen, warm welcome to you. Let's just sum it all up. Weakness pretty much any market you care to finger today. And again, the governor might have tried to sell it glass half full, but in real terms, this market's running to a different tune, right, Mike? Mark?
It's been running that way since January when you think about it, Carson. It's been interesting how if you went on that, I mentioned to everyone, if you went on the Christmas break and came back, the world had shifted somewhat and you couldn't really put your finger on what had happened. And I think when the Japanese Bank of Japan came up and said, you know what, we'll move rates to minus 10 basis points, you didn't know what it was, but you knew that it had concerned and had made a lot of the central banks very nervous. And we see that in the RBA, in that they are trying to jawbone, and we see it with the Fed, trying to talk about the positive nature of the economy, but then they do talk about the currency wars, and the currency wars are looming large, and if we rally, it will be very troublesome, to say the least, for the RBA, and I think they'll just put ongoing pressure on interest rates to go lower, whether it be the market driving rates lower and the RBA to follow, or the RBA leads. But it certainly has some momentum around this lower for longer, and it's that definition of what longer actually is. Worth
pointing out, though, that the dollar actually rebounded in the wake of the decision and didn't stay, in a downward pattern. Pete, what's really interesting this month, everything Mark just said, but added to which a standalone paragraph on the Australian dollar and commodities linked directly with the recent run-up. But again, that's the perverse thing. They've actually highlighted something that's only been a phenomenon for about a month, and most of the market is saying those commodity prices can't stay up.
No, exactly right. I mean, where it's sitting at the moment, you've only got to see what's happened as far as crude, what's happened with gold, and all of the markets have had a very large washout. We're very conscious what happened overnight in the US. We're down 10% really in a week, and if you roll that across, it's had such a big correction, then we're sitting here and we're going, well, it's just going to play into our markets.
Okay, Mark Todd, just putting it back on you for a second as well, just the idea that you are in a region that, which speaks for itself, is under... it's under the spotlight for growth reasons, for a sector that once shone, and now, the spectre of an LNG conference next week there, where the mood will be moody, will it not? A lot's changed.
That's right. I mean, one of the things, I've been over here twice in the last month to meet with customers, and there is that sense of concern, to say the very least, and it's really around what will the government do, how will the government respond to, does the government see it as a parlour state? And think about the GST conversations that we had just a few years ago, where the government said, you need to give me back a lot of the GST that I'm already handing out to you, the federal government, and now they're looking at how do you get the right tax mix, and we've got the Treasurer, we've got the Premier now becoming the Tourism Minister and trying to reshape the economy around what are the strengths other than the mining experience into China. And I think a lot of the customers here are trying to look at what is the direction, where can we take the economy if we can't rely on China, and what can we do? And they are definitely concerned. They are concerned about property, they're concerned about commercial property, they're concerned about the implications of some of the foreign investors leaving these shores. So I think there's a lot of concern in the West around how do you adapt to the changing environment.
Through it all, though, the pace of lending to business has picked up. The reserve flags again, as it did last month today. So you go back on banks. They rallied yesterday. just as soon they were sold down today. Where's a pattern? What pattern to make of that?
You know, I find it very hard to find the logic around the banks. I looked at some of the bank yields they were selling. Now, I understand there's dividend pressures, but some of these yields were at 10, 11%, and I was trying to scratch my head and say, I just don't see interest rates moving. I see the base rate going lower, if anywhere, and that margin that you can get over the cash rate for some of these banks didn't make sense. Not necessarily... I'm not saying they're a great buy, but I just found it hard to understand where the selling pressure would come. And I think that's the sign that the market is artificially long. It's because you don't have very many conservative assets to buy, and you tend to go into assets that you've got a bit of liquidity, and you are forced into those. You know, we talk about taking on the yield curve, the risk curve. I think they are taking on the volatility curve. They're taking on these assets when markets are volatile. They get out of them very quickly. They are looking for, again, that sort of direction around where will rates go and can banks perform. And I think banks are showing that they can perform. It was only a few months ago they gave some great numbers on their performance. I just feel that the market doesn't believe. They're finding it very hard to trust any asset at the moment.
The other concern, Pete, and coming on this and maybe look at some parallels of the US, cheaper energy was meant to
stimulate economies.
It was meant to stimulate economies, and we're getting every signal, even domestically, on the CPI, TD...
Absolutely. Inflation's well down, so that's not a concern.
Yeah,
you know what the big problem is? Banks lent to all of these mining and, of course, all of the supply chain going across the whole commodity sector. The second part is that you've had such a solid washout over the last couple of years that you've now got sovereign wealth, you've got everyone from the Saudis, the Russians, and you name it, and every player in between hemorrhaging. So that's the condition that they're living under, and we've got a new normal coming in as far as that new energy cost. What is going to be the base? Any market that can fall 10 or 12% in a week, and you'd think, oh, well, is that a small market? No, it's crude oil. So that just shows the huge dynamics at play, and where it's sitting at the moment, there's every chance you're going to see 32, 33 over the next sometime in April.
But okay, isn't that meant to be net positive for commodity importing nations? For Japan, for China.
Yeah.
Again, neither is able to be pointing to shoot the lights out numbers. A soft kind of target for China.
Absolutely.
A sense of Kuroda having to ride to the rescue on Japan sometimes.
Exactly. You look at the Tokyo market today, down about 2.4%. So all of Asia has been pretty hit hard. If you see that commodity complex come off overnight, which we saw it all through daytime trade today, and everything, 9 out of 10 Asian markets, Singapore and Tokyo were the only markets, pardon me, Singapore and China were the only markets that green territory.
So as an investment thesis, is this actually a shorter's paradise, you know, even on...
You know,
still, I mean, the hedges on, for instance, crude.
Absolutely.
Where are you seeing trends
they're now starting to jump back in as far as bearish trade. It was a turnaround. This time last week, we were very conscious where the US dollar was. We were always saying, are we at that headline number that's really going to have resistance to the upside? Where's Iran situated on all this? And everything's come into play, and everything that was forecast a week and a half ago is now matter of fact. So at the present time, I think there's going to be continued softness rolling all across those energy and other markets.
Mark, the complication, the word complication, or complicate to be more precise, about the adjustment that the Reserve has meticulously masterminded now in the wake of the mining boom. They've created a standalone $8 paragraph today, and they begged to voice a concern that the adjustment just might be looking threatened the higher the $8 goes. What does that speak to in a similar way with corporate America disappointing because of US dollar strength? What might it start to do for Australian corporate expectations?
I think it's a really good question, because I think that's where you capture the difference in the two economies. One is that internal combustion that the US offers, and if it doesn't go exporting, it can go internally and it can sell into goods and services to a 300 million population, a $300 million consumer group. If you look at Australia, we don't have that, and we have seen a very nimble response to that change in currency. We've seen great responses from education, from mining, from tourism. You've seen the benefit of the lower oil in the fields of Qantas and the like, but you have seen that the Australian economy rebounded very quickly from the mining to the non-mining, driven by that currency. And I think it's obvious that the RBA is saying we jawboned, but patting the back to the Australian economy for doing such a stellar job. 3% GDP, it's been fantastic. And then you say how will it adapt? Does it go into a jobless recovery? Does it have the corporate Australia then starting to say that we can't pay wages, we have to, take some IR changes into the election because we need to be more nimble? And I think that's part of the problem that the RBA will have, trying to get that currency lower again with interest rate settings here as that weight of money. Now, I'm talking about the periphery money. I'm not talking about the massive amounts of money that goes into US Treasuries, but it doesn't need a lot to start impacting our economy by people trying to buy our assets. And, you look at Kingston, you look at some of the farming endeavours, you see people trying to buy $350 million worth of farmland. You see them buying HealthScope, 15%. You start to see a lot of money coming to this economy. You start to say it's to buy the assets, and that means the currency continues to go higher and makes it harder for some of those outward-looking economies to sort of take advantage of a lower currency.
The other point raised, and we'll get on to later in the show, Dr. Shane Oliver was with me at the Reserve Bank in the wake of this decision today, saying, Peter, that the last time the banks moved out of cycle, irrespective of the RBA doing nothing, towards the end of the back end of last year, pretty much it was a benign real economy response, okay? But you do that a second, if heaven forbid a third time, which is being talked about actively. And what are the unintended consequences? What are the spillover into retail, into key services?
But one thing different this time around, we've got an election called, and that's really going to be the mainstay. And I think that at the undercurrents at the present time are very, very fragile for the incumbent government, and they're very conscious of where it all plays. So whilst 15 was very much a different year, I think. We saw that large correction as far as the Aussie dollar. Where it's sitting at the present time seems to be trending further up, closer to that 77, 78 mark. And I think that the RBA and the levers that they can play with are a different agenda coming into an election period.
So an election will basically, in the public appropriate...
I think that would put the handbrake on it. I don't think you're going to see anything happen as far as RBA and rates, at least till July or August.
Mark, do you agree? I mean, particularly if banks are given an ultimatum by Basel, for instance, which is really way outside anyone's ability to trump. At that point, how can the banks just do nothing, irrespective of an election domestically?
I think there's two separate things. One is, will Governor Stevens at the end of his career hand off to, let's say it's Philip Lowe, will he hand off to Philip Lowe a cash rate at 175, or would he say, I'll leave you with a cash rate of 2% and you can use the levers to stimulate if you see it? And that's in September. I don't see there being any benefit to anyone if they started to cut rates prior to an election or in an election cycle or prior to him moving on. So I would have thought that he'd leave that. In terms of the banks and how they fund and how they manage that cost of capital, I have great faith in the management of the bank saying, OK, how do we become more efficient? And I don't think of it as a singular response. I don't think cost of funds are here, this is where we're going to have to charge the clients. I do think they look for things around the productivity, so the impact of the cost of funds is much more varied. And I do think they're looking at more granular responses to their books. So who is the buyer? Is he an investor or she an investor only? That might be a different rate to the owner-occupied. So I think there's more granularity around than what used to be because you just didn't have the systems. You now have these systems at foot that can tell you that, the stuff that they can work out on their book now, borrowings, is phenomenal. And the lending is quite extraordinary.
But the fact that they did it last year, doesn't that imply that they have an appetite and a willingness to do it again?
I think it was just the timing. It was just around how APRA was trying to assess it. And remember, the
also waiting to see what Yellen does.
Yeah, Pete's saying the Yellen connection wasn't as live then as it is today.
Absolutely. I mean, that's the big point.
Right.
And the bail conversation, Carsten, just to butt in, remember our timeline is 2018. It's not as if it needs to happen in the third quarter of 2016. That's not necessarily where it needs to be. So it's about how do you fund your book in the most efficient manner and how do you get the best return on equity? How do you do those two things? And then how do you look at provisioning for 2018 and what you need to do? And I think that's around, a lot of different capital levers that they've got at foot.
And it was a nice way of you putting, even though you didn't characterise as this, but Glenn Stevens will leave the dirty work to his successor, you might well say, because he's today flagged the complication on the adjustment, the structural adjustment, but he's not willing to intervene. He'll leave that for others.
A la Greenspan.
Yeah, exactly.
You can describe it as dirty work, Carsten. I won't describe it as the dirty work.
No, you won't. You'll play the
heavy
diplomat.
lifting.
Yeah, we'll use euphemisms to get around the topic, but then ultimately you have to call it a spade at some point. Maybe not today, but yeah, the memoirs will, the historic memoirs will make those links. We'll take a break, and yeah, it's all down to mood music, isn't it? Glass half full or half empty. When we come back, our volumes, we're across that one. We'll check in with Patterson's for some standout stories on markets after this break. Here we go into the match out settlement, animating for you a fall of 1.4%. This is looking awfully sort of unfortunate to have psychologically even just undershot the 5,000 mark. It's a 1.4% decline, and you saw pretty significant energy losses today. Standing out, Santos with a 5.3% sell down, a near 5% loss on Beach and Oil Search individually. Woodside.
BHP well down.
Indeed, you go into materials.
3.3, I think.
Let's bring in Tony Farnham with my panel of Pete McGuire in studio with me and Mark Todd from the NAB over in Perth today. Tony, welcome into the show. A volume pulse check today. Are you going to say it was heavy selling or more muted?
Yeah, there was sustained selling, I'll say that. Volumes are getting around the 5 billion mark as well, getting through that match-out period. As you've touched on already, Woodside sold off quite a lot. BHP got a bit of touch-up as well, as did the 4 major banks. BHP actually, Woodside around 11-year lows.
So, just put it into context, Tony, on yesterday, some of the drivers on the selling, where do we look to? What do we take from this?
Yeah, well, look, in terms of the commodities type stocks, it's pretty self-explanatory. Further fall in commodities as the recovery process was mentioned in that RBA rates decision today is, I won't say done and dusted, but it's certainly been taking several backward steps. And what we got, Westex Intermediate again around that $36 mark as people start to get very sceptical that production freezes will be delivered in mid-April at Doha meeting.
Panel, come into this. Have you got a view, Pete?
Well, exactly right. The issue at hand is, and I agree with Tony completely, the storyline is Iran. That's the outlier. We've mentioned it week after week after week, and there's no chance that they're going to stay happy with the production they've got. They want to increase it. And the sanctions were lifted, and that was more or less the deal between all parties. Now it comes to a push and shove, and they're saying, well, no, they're not going to have an increase. So the whole, if you look at the sector from the Saudis all the way to Russia and all across every component, everyone is hemorrhaging.
What are we more worried about, though? The benefits that we've just articulated for the real economy, which right here, right now, we should be...
More wallet and more purse spend.
Yeah. Or are we worrying about toppling XYZ regime because they start to look awfully self-centred via everyone else, and they worry about their own domestic bank balances rather than the greater good?
Well, of course, but the other side of it, where you look at it holistically, that there is more spend as far as the retail market, and mums and dads have got more money in their pocket because the petrol bowser is taking less. So the trade-off is, are they going out and spending those extra dollars? That's the dilemma.
Okay, until that happens, Tony Farnham, energy is just essentially a whipping boy for how many months?
Well, I would think that the supply story is not going to go away anytime soon, so I just can't see a story that's going to revive these guys, barring some massive geopolitical event coming through where you start get that premium added back into the stocks again. And
can you think of, in historic terms, I mean, here we have Pete, the yearbook, going way back to
you've got to go back to the 70s oil crises. You've got to go back to the 80s, of course, when you've got issues as far as the Strait of Hormuz and tankers being taken, or you see weather outages and hurricanes in a sweeping season like you saw in 05 or pardon me 06 when you thought about Hurricane Katrina. So if you see a succession of hurricanes, you see geopolitical and other
if you see perfect storm, right,
then you're going to see crude higher. But at the present time, I think it plays into every market. We saw that today as far as what happened in Tokyo.
Mark, what happens? I mean, we've agreed bags exposure in this regard is what it is. It's not as you'd say, material. Again, though, for investors, what are their options? These are top 20 companies, top 50 companies.
Yeah, that is a challenge. You think BHP off 3%? I think it's now under $16. The banks have been, crushed.
Yeah.
I guess the thing that I want to try and understand, and maybe Tony could help me a little bit on this, is that I don't think that the 900-pound gorilla in the room is still the GFC. It is still the way the consumer reacts to the GFC, because if oil is where it is, why are we not filling up
Correct.
and driving just for the sake of driving? And why are we not then saying to your wife or partner, look, I've got an extra $100, let's go to dinner, let's do something. Now, please don't everyone ring in and say, look, the restaurants are full. But you get the sense that there is a complete lack of optimism around what the implications for the lower oil, and the central banks haven't yet addressed that 900-pound gorilla, because I think they don't know how to do it.
Well,
and
yet they push people down the risk curve to engineer risk-taking, and then there were blow-ups, as markets are wont to do. They don't run in a straight line, so it was kind of tacit, if not overt, led by central banks.
So I think as a consequence, Carson, if you look at the small cap sector in the equity market, I think that's a wasteland. I think there's no one taking phone calls. No broker can ring a client up and say, would you like to buy a little bit of this? The only people that play in that space are now the fund managers, and they extract an enormous price. And I wonder what the implications are for corporate Australia when you are a small cap trying to make your way in life and find out that where you traditionally would have gone for some equity capital, you now can't go there.
Tony, what's your view?
And
Tony
how
Farnham.
that plays out.
Yeah, Tony, come into that.
Yeah, look, I've talked about this one before. I think some of the, I'm talking mid-caps here, in the tourism space, they're doing quite well, thank you very much. And quite a few of the food guys come back a little bit of late, but others within that group also have a thematic that people like as well. I say in terms of consumer, it's one of those other big ships. You had a central bank for many, many years saying you've got to be more frugal. Now you've got a central bank and other central banks across the globe as well imploring their consumers to go out there and spend a little bit more. That change in mood takes a while to get happening.
But you talking about consumer bit players. In fairness, I mean, Pete McGuire. You look at Bright Foods and the real global marquee conglomerates. They don't just have one boat to one destination,
of course not.
Right? They are multi-layered.
Absolutely, conglomerates across many different sectors. You know what I think the real issue is? We had a market that peaked nearly at 7,000 points at the end of November 07. It crashed to 3,300 in the GFC. March of 09. It's recovered 50%. Let's not kid ourselves. 50% it's recovered in 7 years. Have a look what the US market did. Have a look at other mature markets. They've outstripped us, and where we're sitting at the moment, I think there's fragility. The next part, of course, is there's no consumer confidence in the stock market, and people are looking at other asset classes.
I.e. default housing.
Absolutely.
So, Mark, they're not going to come back, are they? What brings them home?
No. No. I think you're right. I mean, I think it's very hard. Housing, great. We've had a lot of people go into commercial property and say that that's offering great, great options. But if you, again, I say, okay, the banks are at whatever they are, 10, 11%, and I'm struggling. So what I think it is it's about the white noise. I think it's about the complete sense of, I am a naturally nervous investor. I'm nervously being forced to go long, and I don't like the market. I don't like that sort of volatility in markets, and I think they are looking to take de-risk their portfolios. And my greatest concern has been, and basically I've been over the last month visiting customers and saying, why are you so overly invested in cash? And I think a lot of people, you look at the term deposit numbers, that is a phenomena that we need to understand. How do we give clients assets that are conservative, but at least giving them better than 2.5%, 3%, because they need to get a better return. Otherwise, we will have a real train wreck happening 5 years from now when people look to retire and won't have enough money.
And Tony Farnham,
They'll work longer.
It puts the RBA in it puts the RBA in a bind. It can't basically raise rates either because it will unwind the whole alternative.
Well, they're worried about the Aussie dollar, so they're export driven. So you're taking on that side of it. I think we're in for a long run as far as low rates. Have a look. Put your mind back, and I'm not saying we're going to get to a Japan situation, but their market in '89 peaked at 39,000 points. It crashed to 8,000. It's sitting now at about 17 or 18,000. Now that's 27 years later. So it just gives you some sort of an idea. Markets don't come back in a big hurry, and that was demonstrated by our market up 50% in 7 years from its lows.
Maybe one critical difference: we are an immigrant nation.
Oh, Japan's got an ageing population. It's got there are many differences, and it was an economic miracle, certainly like Germany in the 50s, 60s, and 70s and 80s, and it outgrew itself as far as market, real estate, and so on.
And Silicon Valley stole its lunch.
Yeah, probably. Yep. Whereas our market certainly, peaked at that 6,900, 7,000 point.
Tony Farnham, something glass half full to finish on from you.
Yeah, well, I think the RBA announcement there today increases the chance of another cut, and perhaps May, perhaps August, and it'll be driven potentially not by what's happening globally. They don't give a damn about that. It'll be driven by what happens in our job market, and also as well, of course, a bit of jawboning as well, which is great, to put the US Treasury in its place too.
Yeah, all right. Yeah, the blame game, jawboning light. Thank you so much, Tony Farnham from Patterson's, the panel of Mark Todd from the NAB in Perth, and Pete McGuire with me in studio. That continues after our short break. We're back. Just stay with us after this. Well, welcome back. No imminent signal of a cut from the Reserve Bank today. It did, of course, list some of the smoking gun components that goes into its deliberations every month, but nothing's flashing amber at this point. The dollar, therefore, unable to do much other than go up on that kind of realisation story today. The market had a mind of its own. A reminder, if you just joined us, we did really underperform even regional counterparts with a 1.4% sell down there on the 200 and some pretty overweight selling seen in energy. Let's go down to the dealing room to the minute though. Mike McCarthy at CMC for you. Well, sentiment very much from risk on to where was that story, Mike? It's kind of very fleeting.
Well, there's certainly a lot of pressure on the market today, Carson, but I think we could suggest today was as much a currency play as anything else, and the volume tells the story. We had, in cash terms, just under $4.3 billion worth of shares change hands. That's about 5% shy of an average day, yet in futures terms, we were more than 10% above average, and that tells us what was dominating today. It was the top-down selling that really knocked the market around, and where there wasn't buying in a sector, and the sectors where we saw buying were the defensives. We saw buying in property trusts, in utilities and telcos. Those defensive sectors did relatively better, falling by around 0.75% compared to falls of around 1.5% for most of the major sectors, and real pressure on material sectors with both energy and mining stocks taking it in the neck today. So it was an inverse of what investors were up to. Where investors were supportive, we saw sectoral outperformance. Where there wasn't investor support in the market today, that top-down selling really knocked some sectors around. And it came down to those usual suspects, the banks and the energy stocks as the worst performers on the day. And I think that top-down selling, which was absent from the market yesterday, was as much related to the RBA announcement today as anything else, because it was widely expected that we would see some jawboning from the RBA. If you're an international investor, Australian shares are a two-part play. It's not just the outlook for the share prices themselves, it's also the outlook for the currency. And if you're expecting to see a currency turn, and there are a lot of traders in that boat, many of them having called high somewhere between 77 and 78 US cents. When the currency does turn, that gives added impetus to the selling. It gives added confidence to those who are taking that two-part play on the Australian market. Now, it wasn't just Australian shares that were hit today. We certainly saw pressure across the region, with Japanese shares down by more than 2%. Mainland Chinese shares the exception. They are up, but in Hong Kong we saw a similar fall in the market. It does suggest that that very sour sentiment around the potential for concerning developments in the Asia-Pacific region was expressed from the macro level today.
What was your thinking out on the link with the commodities story? And we've been tracking that 200-day moving average and breakout and a link to where crude's been patterning. But in fairness, this is only really a month story, but they've latched onto it in this decision today. They've pulled it out and highlighted it. Are you surprised that they elevated the gains in commodities to that extent when still market pricing is for further falls, not further strength?
No, I think that's a very important part of their strategy at the moment. The RBA is aware that if it talks against the market and the market does the opposite of what it suggests, then its credibility is damaged. And so they're very careful not to be talking down the currency when it's clearly and strongly rising. I think that's why we've heard so much about commodities and the impact of those lower commodity prices on the Australian dollar. It removes that direct causal link if the Aussie continued to rise. I do expect to see more of it. I note too from the RBA statement that they removed some of the language around concerns induced by international volatility. And in fact, the removal of that statement seemed to indicate that they're no longer as concerned around the impact of market volatilities across the region as they were. It makes sense in this interconnected world that they would try and finger the culprits. And we do expect to see lower energy prices. They're moving back towards the middle of the range between $26 and $42 for West Texas. And that's a natural occurrence. A lot of people are fingering that announcement from the Saudis on Friday night, but plenty of technical players were calling for that sort of move, as were a number of global analysts before we saw that meeting. So I think we are seeing further pressure on energy. It's dropped now for 6 straight sessions. We're likely to see further pressure before we get to around 32 or 33 for West Texas, with some indications already that the momentum is slowing. I'm sure that Glenn Stevens would like to see it below $30.
I'm just wondering what Glenn Stevens knows that Janet Yellen doesn't know, because he's in dismissing those global volatility issues. The Fed's by no means dismissed them from its watch list. And, well, to you, Mark, Todd and Perth, come in on this one. We've still got Brexit ahead. We've still got banks in Europe looking awfully problematic on the balance sheet. Where's that clean-up story? Where was I when that happened? And where were you when that happened? And where was Glenn Stevens when that happened? It hasn't happened.
No. I think we haven't spoken about it yet, but obviously it's the political story. Is the $64 question? It's, you know, how does the Turnbull government bring out a budget? How has Cameron got himself into a position where, having joined the EU in 1973, they still haven't made a decision on whether they want to be there, and now the ascendancy is if you like in favour of Brexit, against being part of the EU, which seems, you know, kind of crazy. And when you look at it, I've been doing some reading on this stuff in the Brexit. You do see the lack of political leadership in that they can't point to Europe and say, we need to be part of that. They point to, you should be scared if we aren't part of that. They don't talk about the benefits, and they can't seem to be able to articulate the benefits. And I think that's the political paradigm that we're all suffering from right now.
Do you blame them, though,
Mark?
Mark?
Leadership that will lead.
Okay, did you blame them, though, over the months of prevarication over Greece? And we covered it for months. You were part of the conversation, as were the rest of the panel. If Europe did it to that degree over something as minor as Greece, what do they do on the big issues? They're basically incompetent.
Recognise that Donald Trump is the leading contender for the Republican Party.
No,
so
I'm talking about, let's talk about Europe.
Okay, but hang on, you can't hold the European politicians to a different standard. Look at Abenomics, where they had a fourth quiver that they haven't actually unleashed it. You know, that you can see that there's a human dynamic in Japan that the politicians won't address. So it's not just the fact that Europe can't do something. It's the fact that you can't say that we are better as a community to stop things like terrorism, financial instability. We need to be able to work together.
They've shown absolutely no ability to contain either of those issues. So what's the advantage to being together?
I'm talking about if you had the politician of a stature of a Howard or a Keating or a Hawke or a, you know, even a Whitlam that can articulate it. I'm saying no one's actually stepping up to have the argument. I'm not saying that they should do it. I'm just saying they aren't even arguing for their own case.
Okay, Mike McCarthy, your view on that?
Well, Carson, I'll take a step back from that. I'd like to point out a month ago, all of the negativity was around China. We've now seen some better manufacturing data. We're likely to see better services PMIs over the next week. And yet, so that risk that so many people were so concerned about and sold on the back of has now been wiped from the discussion.
Do you believe that
and
it's
this is one of the issues for the market as a whole. There is a relentless focus on the risk.
Yeah.
And even when those risks are not realised in any way whatsoever, in fact, the data directly contradicts them, there's no apology for those who are so
you're the only
viciously calling
person.
the market down,
you would be,
and then they moved on to the next risk.
Mike, you would be the only person who could stand there with a straight face and say that they take Chinese data and they really take it as gospel. Frankly, it was worrying people because surely there was a gathering.
Data from all around the world is an estimate.
No.
It's all rubbish. You either accept some of it, you either accept all of it, or you accept none of it.
You go to the Bloomberg terminal. How many people are now giving estimates on China? About half what they were a year ago. You know full well the investment banks have pulled back their analysis. You can't get an estimate.
Carson, look at non-farm payrolls. You don't want to try. You don't want to go down. Michael's right. You don't want to go down to non-farm payrolls.
No,
and say, is this a robust?
Australian job data.
I was searching for a reason why China was no longer principal concern. My argument, and I was wanting to test your views on it, was presumably we went from a China gathering in Beijing to set forward policy, so the eyes of the world fell on it for a deliberate reason. That meetings come and gone, we move on, but still, Pete, have the concerns gone?
No, I don't think the concerns are gone in China, and certainly after the Lunar New Year we moved into major issues in January. We all saw major sell-offs, and then moving forward into March there was a revitalisation as far as equity markets. It was a very strong uptick. Everyone was a different level of confidence, and over the last matter of days we've just seen that I suppose exhausted, and that's where we're sitting. So it's a very much, when you look at trading, there's a very different view between trading short term and trading for a longer term. And at the present time, I think many retail investors are trading for the short term.
Okay, but Mike, you'd agree with that, would you not?
The many investors are trading for the short term.
Yeah, exactly.
I'd say the focus is very short term. I think the real winners at the moment are those investors who are taking a contrarian approach. When the bear rhetoric amps up, that's the time to be buying. When the bull rhetoric amps up, that's the time to be selling. And that's what's worked so far this year.
So almost you do the complete opposite to the herd.
That's right.
And again, when does that become a mainstream position rather than a fringe?
Well, you know, markets will eat themselves eventually, Carson. Eventually, the learning that comes with that, we'll see a more rational approach to investment. At the moment, we can only deal with the market the way it is at the moment. I point out, for example, at the moment, after the fall today, the dividend yield on the 200 index is now 5.2% without including any franking. Now, unless you think there's about to be an implosion in earnings, that's a fairly compelling argument in a 2% interest rate environment. That doesn't mean the market can't go lower. It can. Sentiment can drive a market well below what it should be or well above what it should be. But we're starting to get to levels where the underlying numbers are so simple and so straightforward that eventually the sentiment must turn.
And a good crystallisation of that coming with Amcor today, right? A 3.3% rally. Does that capture pretty much that theme in one stock?
Yeah, I think it does, Carson. It's a good point you make, because this is a stock with a defensive earnings profile, but it's exposed to both growth here in Australia and around the region. It's a packaging business. We've got a great earnings income. The dividend yield here is not attractive at all, and yet this stock is within a few cents of its all-time high. It's in that sweet spot. It's not exposed to retail, but it's got good earnings profile. It's the one that's benefited from all of this pullback. So even in this bearish market today, we've got a stock making its all-time high. It goes to the point investors have to put their money somewhere, and if you're sticking in a bank account at 1.5% or under the mattress, eventually what's going to hurt you is a lack of returns.
It's interesting, that one as well, just because they were flagging back in Feb a full-year earnings profile that was likely to improve. The market today obviously got that validation, but Pete, again, do you sort of worry that valuations begin to look stretched because your opportunities here?
Well, they're industry specific, they're company specific. It comes down to strategy, it comes down to competitive forces, it comes down to if you've got a green light ahead of you or a red light. And there are many companies out there that have got green lights because they haven't got a lot of competition in their space. But there's others that are crowded markets and they're going to have issues as far as growth trajectory. So when you look at companies, you look at balance sheets, but you also look at future earnings and competitive. And Amcor's got a fairly good green light ahead of it.
Okay. Which is another way of saying, yeah, when you have that ability to crowd out others, but you don't have that forever.
No, you don't. It's competitive, and that's what markets are.
Mark, Todd, coming on that one, thoughts from what you've heard?
I think stock picking right now is another man's game. I think 85% of the population are struggling. And I think 95% of all fund managers are absolutely struggling. And Michael's probably right. If you take a contrarian view, you'll do okay. I do think what you really need to do for that 85% is just to find a portfolio strategy that is as granular as you can take it to be. So you might trade 10% punt in Amcor, but the majority of it will be what's your cash, what are your hybrids, what are your fixed income, what are your equities, and then literally turn it off. Unless you think this thing's going to go under, let the management do their job and try and, Mike was saying you get a 5% return. They're good numbers. I mean, you need to think about what's the macro cash rate. We will be at this level for years.
Right.
And if you're getting 2.5, 3 times cash, you'll be all right. That's fine. You might not make the 12% that someone else is making. That's just going to be the green monster. But the reality is you probably won't get too badly belted up when you make 3.5 times cash, and you won't have to worry. It'll be a less stressful experience. And I think that's part of the theme that people need to focus on. What's volatility doing to your your retirement, your investing, your quality of life? What's it doing?
And it comes out
this is not logical.
It's that old instruction: don't lose me money, which we heard time and again. Back in focus. Mark, final thoughts as well on tomorrow, even as you look ahead. Mike McCarthy, rather, over at CMC.
Well, volatility to continue, Carson. It's the one call that we've been able to make with confidence, that the conflicting currents coming from central banks around the globe mean this volatility is likely to continue. Investors need to strap in and be prepared for that. But there are, of course, tactical responses too. And the asymmetric exposures, the one-sided exposures that options and hedging instruments like CFDs can offer, can be very useful for those investors who are concerned about the capital outlook. But of course, there's also the strategic component, and that is the asset allocation decision. And that's the one I'm referring to in terms of contrarianism. When everybody's saying that equities are about to plummet, that's the time to get involved. When everybody says equities are about to hit the sky, that's the time to sell out. That's the strategic outlook. At the granular level, it's about asymmetric exposures and stock picking and active investing in this highly volatile environment.
Yeah. Goodbye to set and forget. We take a break. Thank you, Mike.
Thank you.
Talk to you soon. Mike McCarthy there at CMC. We will ourselves take a break. When we come back, for you, biggest movers, we'll give you the rundown on that measure. Welcome back. As promised, the best and the worst now for you, captured in 2 charts. Let's go through that list. APN Outdoor, a rally of some 6.4%. And just if you missed it today, some of the headlines that were responsible for that positioning, well, you kind of even just go back a few weeks, talk about the full-year dividend, full-year revenues. Today specifically, was there anything? Not that I was
not really.
Specifically aware of. Amcor, another one, comes out with a 3.3% rally. We were talking about that with Mike McCarthy at CMC, looking at some of what's been going on for it. When you bring all the elements together, the earnings profile is enough to push it to an all-time high. But there's no uniformity, Pete, on that chart.
I mean, you look at 9% for Select Harvest, you look down to 2.9 for St Barbara and everything in between. You'd have to say, if you were looking at those stocks, it's been an almighty day.
Mark Todd, your thoughts? Broad Spectrum, formerly, of course, Transfield, correct?
Yeah. I think, Carson, one of the things that I find very hard to, not be cynical about, but I do add concern to it. I just think it's the herd plays its role, and when you're in it, when you're saying Amcor's got it, they're going to the US, they've got the currency, they've got all these things, you are just literally mimicking the herd. I find when I look at the research, a lot of it is all the same. There's very few people that stand out and say, look, hang on, now take your money off, stop, have a rest. And I am conscious of that US theme about taking advantage of the US economy getting better and buying into the US market and staying unhedged and having the benefit of the dollar. I just don't like that. I don't like that momentum around what the herd's saying. And I'm not saying Amcor is that, but it's certainly, they're dizzy numbers. And I think you need to be able to say you won't go broke if you keep taking profit. And it's one of those things where there's lots of available opportunities. It's not as if everyone's going along and it's all, you're chasing. Remember, a couple of years ago, 2013, you were worried that you would miss the rally. You've got to get onto it. Everyone's moving. That's not the case now. There is an abundance of opportunities around. You just need to develop your own skill sets or or your risk tolerance, if you like, or your volatility tolerance. But I just think it's very hard to pick equities right now.
Do you think one of the concerns was as well, and it's been building ahead of steam, from a self-managed super part of the market, Mark Todd, that investing decisions for the long term have been frustrated as that herd has been ever more influential on a share register and ever more demanding. So you're hostage to that, and your decision and your strategy therefore lives or dies by it.
Yeah, I think the theme on SMSF investing is a little bit misunderstood. I do think that they're the ones that, if you've taken the time to invest on your own behalf and have stayed the course and continue to invest and said, look, I can do this, I'm not going back to my advisor, I'm comfortable. And I think there's a vast percentage of the investing population are doing that. You have tended to switch off from the white noise. You have tended to say, what was the reason for getting involved in this? Is it to punt? It's $1 go to $1.20, or is it literally to take advantage of, I want blue chips that won't go under, and I think that I'll back the management to pay me the dividend they're saying. Now, I am mindful that BHP have changed that strategy, and that would have created some consternation. But for a lot of those investors, when we do the research, they're not listening. They're just not taking on the information, and they're saying it's going to change my behaviour. It'll come back, it'll be fine. And I'm not sure that it will, but I know that they're not worried.
My good view on that? Do you beg to differ, or how do you see it?
They're not worried. I think, well, Mark's correct in, I think, 99%. I think that there is people, as far as self-managed, a lot of them are even exiting equities and putting those funds at play into property, and have looked at other asset classes that they're saying, for a long-term hold, I'll be in this for the next 10, 20 or 30 years. I have greater faith in the property market than I do in equity markets, and that can be a debate in itself. But if you look at what's happened over the last couple of years, there's certainly not a lot of stock on the market. They've had very, very solid run-ups, and there seems to be a very strong appetite for more and more of those funds that were at home in equities finding property as the vehicle.
Mark, go from self-managed to the actual super funds and their remit on returns and the competition that drives every single percentage move outperform v your competitor. What that does to a holding in, say, a bank, and then a policy that's either made or rescinded.
You know, one of the things about the industry super funds and the professional super funds is that you need to be mindful of the fact, and I don't mean this to be disparaging, but it's not their money. And it's a completely different strategy. It's about, I think this is the right price. Okay, they've reassessed it. I'll have another go at it at another price. And they are trading markets. Now, I do talk to a lot of those funds, and they would be saying right now that this is not a logical market and it's not used to my traditional trading strategies. Now, I don't think they're looking to, capitulate, because they have to, by the size of them, have to be in equity markets. They have to be in all these asset classes. They are looking at different markets, and they're saying, should I be in a loan market in the US that will give me 8%? I feel that they are less reliant on the offshore market, and they're looking at these valuations and saying, what am I missing? And I think that's part of the theme for a lot of those funds. They might be advocating some funds because it's in their own interest to talk about offshore, but I do have a sense that they look at the equity market and say, look, it's what I know and what I'm familiar with. The other markets, emerging markets, are like they're very hard to pick right now.
It's very hard to find equivalent walls of money otherwise that basically can swing and hold sway, right? They have built up quite a Goliath-like
Absolutely,
presence.
absolutely.
The only other thing I'll butt in here, Carsten, is that you do think about also some of the redemption requirements. So I'm talking about the demographic story. The idea that they are looking at the valuations, and they're looking at some of the volatility, and they're just trying to make a decision, have I got enough to go back into this sort of situation, and I will accommodate any redemptions or shifts that I might have. So that flexibility in industry super funds and or professional funds just makes them a little bit cautious, but they look at it and say, wow, these are some big numbers. And remember, they talk with the management of these companies. They say, what are you seeing? What's happening with you? And I feel that corporate Australia feels that they're in good shape. We've got a 3% GDP. corporate Australia would be looking at these markets going, it doesn't really make much sense either.
You know, the old wealth measure your GDP, is it really all it's made out to be? We take a break. That's a bigger debate. That's a Piketty level discussion. When we come back, though, from this, we'll kind of bring you into the reality check on a down session with the cast of worst performers captured. Stick around.
Live on Sky News Business, this is Trading Day, the close.
And welcome along to the second hour. It was a weaker session and quite markedly so today. Materials and energy, key contributors to that selling. There you have a snapshot on the material space. Selling there 3.25% on BHP, a 2% plus loss on Rio. Fortescue actually managed to get itself out of the worst of that downdraft. It lost just under the 2% mark, 254. It's pretty much where we'll perhaps leave it and pivot into energy, where there was actually a more sizable component to the selling. Woodside off some 4% plus, 5.3 loss on Santos. That was about as bad as it got. Caltex probably fared the best, but still lost 1% on it in the event. Oil Search flagging a 4.75% decline. My panel been with me the first hour, and we continue into the second. Pete McGuire is along for the ride from XE.com, and we've also got from Perth today, Mark Todd from the NAB. So coming into the second hour ahead as well, joined by guests from London. We'll be going to CMC there, take a opening bell call from Michael Hewson. That's something to look forward to coming up. And also Shane Oliver, as he reflects and identifies some key changes that the Reserve Bank chose to highlight in its no change, but definitely a jawbone light approach to its decision today, the way it chose to sell it to markets. Okay, let's get a view from the panel. Pete, just again, we're now...
You're a quick two-sentence.
Yeah.
You know, we've spoken about this company many, many times over many years, Codelco, largest copper producer in the world. They're saying that they're going to see till 2018 you'll see some form of a recovery. Now, what do they say about copper? Barometer, as far as global... the globe, everything is Dr. Copper.
Yeah.
So when we look at those and we look at those forecasts, the largest producer in the world saying it's not going to see any real sunshine till 2018, that shows us that the next year and a half is going to be a very, very rocky road. Now, you play that into, of course, the energy space. Have a look what happened to the miners today. Have a look what's happened globally. The market is very much awash with all of these because you saw the shipping industry. Look what we did as far as all of that CapEx spend across over the last decade has now produced that much of everything that we're saying, well, look, the demand's got to be there to match it. Demand's not there as far as oil, demand's not there as far as copper and many of those other base metals and precious metals.
Mark Todd, that's a good call out. And another C, incidentally, there's Codelco. You only had to go back about 4 months to read Cargill, the unlisted giant. Really, again, pretty bearish, but few people were probably reading it. But I mean, in fairness, who are you listening to? You've got Codelco, you've got Cargill. Who are you, minded to listen to?
Well, okay, so I look at the bond market, and I was talking to clients yesterday. Anglo bonds were at 11% for 2 years. Some of the numbers in the bond market is where I think you should point to, because that's where, it's slightly safer, higher up the capital structure. What prices are these bonds trading at? What are they extracting as a return for 2, 3, 4 year returns? That points to the level of risk. I'm mindful that management will talk up, and tend to and can't help, will talk up the positive story, or they will try and predict that it'll be hard road to hoe, because they've got certain dynamics around at foot as a company. As an equity story, it'll be different. But the debt markets tell you what's the likelihood of them paying back their debts. And when you get 2 and 3 year and 4 year coupons, 4 year returns that are 8, 9, 10 and 11%, that says that the market doesn't think they'll recover in the next reporting season, if you like. The market is definitely concerned about all the commodity laced assets.
And do you see any distortion to the trade that gives you that trend? That is to say, the players in it, the way the complexion might have changed, say, from pre-08 to where we are now.
Yeah.
Oh,
that's right.
Well, yeah, what to make of that?
I was just talking to somebody here, just trying to get the latest numbers because obviously I've been travelling. Anglo's at 10%. I think what had happened, running up. If you think about Yellen and you think about QE and you think about the chase for yield, that has all changed. And what's happened is in the energy sector, in the commodity-based sector, they could borrow at such competitive rates that people were swamping them with money. That's now changed. That is, it does not matter what the story is. People are reluctant to take the risk. And I think that points to the fact that, and Pete might be able to help, no one really saw the commodity schmozzle that we now have as it arrived. I remember reading stories about China, hoarding copper in factories and repoing the copper.
Yeah.
I mean, it is crazy to think that was the analysis on the commodity space and they got that wrong. I find that very hard to understand how you can then point to saying, I expected to rally, because you didn't really point to it having the loss you did. Otherwise, you wouldn't have suffered the equity that you did.
And on a similar vein, we never got to the bottom. As those stories, again, were gaining currency. We never still know what percentage of that, their hard, cold, hard commodity was being siphoned off as collateral on loans. And that was apparently a trend, a very popular one.
Well, shadow banking, and you look at all of that. So how did they fund the actual purchase? What was was it government funds? What was the strategy? We're all understanding you can't believe the numbers necessarily coming out of China. Where can you believe the numbers? And then it plays into it. Then when markets do sell off, and as we saw that really from the best part of 09, 010 onwards, we've had a couple of times in there we've seen some nice little corrections, but it's just been a downdraft or an absolute washout over those last really 6 or 7 years. Yeah. And that's very evident in what impact that has to a commodity trading nation like ourselves, and that's demonstrated by our equity markets.
Yeah. It's interesting.
But you think of, sorry to butt in again, Customer, but you think of something like Glencore.
Yeah.
And you think of the way Glencore, the confidence, I won't call it anything other than confidence, but the confidence they had about telling our big miners, telling Rio and BHP that their business model was wrong, they were making too much, drilling, taking out too much of the asset, producing too much, and they were lecturing them on what to do. They were the commodity trading powerhouse, and they've completely got it wrong. And it's one of those things where you say, maybe the king has no clothes. It's just part of that. When you're trying to build out a portfolio, how much do you take as gospel? We question Chinese data, but I'm questioning all the white noise. I'm questioning the herd, and I'm saying, everyone just take a breather and try and understand what's happening. And I clearly China will get to the point that it needs to, because it's a command economy. It will do it. What's the cycle? Is it over the next 3 months, or is it next 5 years?
Just on Glencore, though, did you ever imagine that they would tell a rival that they were doing a good job? I mean, that's kind of the nature of...
That's the game they're in.
Whack your competitor, right?
Yeah.
But they said that, but again, but remember that you don't need to put your head above the parapet unless somebody wants to shoot it. And that's what happened. They put their head up and they made some commentary, and the market turned to them and really drilled into them, and they came back very chastened. They did a rights issue, which they wouldn't have thought they were doing, and they had to then repay an awful lot of debt. So it literally changed the way people were viewing them as a company. The herd started to change. They would have had this aura without putting their head up and saying, you shouldn't do the following. And I just think that was a strategic mistake.
But do you think it was strategic, though, from a mistake, though, to a positive? They also went beyond commodities, didn't they? And they opened up the trade in a bigger, significant way. So they weren't just getting it out of the ground, they were in real time facilitating.
Of course, and all levels of the supply chain. Yeah. And then that just gives you an idea that the complexities of that market. I mean, it's not as though that you're making, a bolt or a widget. Sure. You've got so many different levels. You've got to remove it from the earth or from deep water or grow it on a farm. Then it needs to be transported. Then it's got a maturity. Then you're looking at, if it's a grain, how long does it last for? Then you're looking at the consumption. We got to a point there that, when you're looking at corn prices and ethanol, feedlot as far as pig and of course animal feed across the world was going crazy as far as protein consumption. And they were changing their habits to go from a rice-based culture to a meat-based. So higher protein, all those stories, you put your mind back. what was the evidence? And that's where, you know, the Glencores and Cargills and Louis Dreyfus all bought that story.
I just wonder whether they became, in their own way, too big to fail, because everyone became so reliant on some part of
that consumption chain. Right. Yeah, but it wasn't unusual. I mean, when you've got not hundreds of millions, but billions of people coming up the curve and changing their dietary habits, that they've gone from a bowl of rice a day, all of a sudden now they're saying, gee, that meat tastes nice. Yeah. I'll put some of that with the rice.
Let's get obese.
That's what happened.
Here we go.
Yeah, but well, that just changed, and that was just all the way along, and it became very evident. Now it's things are a little bit cheaper.
Yeah, things are a little bit cheaper. Mark, how do you reflect on that? Just back on the bond lead indicators too. What are they suggesting as far as stress? Where is it really being most felt, or likely to be most felt?
Now, Carson, I'm a glass half full guy, so let me tell you a glass half full story. What has been happening this year, which is really quite interesting, is that if I use the investment grade issuance in the US this quarter, you've had something like about 350 billion of issuance in investment grade. That's the important thing to think about. Now, I would have thought you would have had about at least 600 or 700 billion in bids. So there's been a lot of people trying to buy investment grade. The cost of borrowing has come lower because of the weight of money. And what seems to have happened is they've cast aside the sub-investment grade, the non-investment grade. So they've said, I don't want to take any of the high yield. So that's tended to move a little bit higher. And they bought into the investment grade because they're looking for some conservative outcomes. Now, the non-investment grade has been bought by the PIMCOs, the investment funds, saying these are good opportunities. Now, that's a trade for 3 to 6 months. But the longer term is really interesting dynamics. The reason being, a lot of companies are able to issue at very competitive rates because the sovereign curve has rallied so far. Governments are buying sovereigns, governments are buying other governments' bonds. So where will I put my money? I want a conservative organisation. I go to a high-quality corporate, and they're coming to market, and that's tending to be the response. So high yield, leave them alone. Don't play as much, but go for investment grade and buy as much as you can because rates aren't going higher.
We haven't though zoned in on energy, and a link here though with activity on and risk and what you are paying in this environment. Look at the Baker Hughes figures.
Rig count.
Yeah.
Frightening.
The rig count.
Again, both of you track it. Just dispel some doubts over that one and where that's heading.
Over to you, Mark.
Yeah.
I can't see the rig count up at the moment because I'm, obviously from Perth. Last thought it was 400.
Yeah, it fell down to 362 last week.
Unbelievable. Last I had was 435. It was about a month ago.
Yep.
The way they're responding, that is corporate America. That is the thing to take out of it. Yes, energy companies are really going to struggle. Energy prices are not going to go higher anytime soon. In the event they do, those rigs will get turned on very quickly. But that is the clean out that you don't see in Europe. You don't see that. You might, and to be honest, you're not really seeing it in China. Yeah. They're just wandering on with bad behaviour around coal, around the environment, and they're trying to make those changes. And I guess they probably will, but corporate America knows how to do it. That country just cleans out and resets, and to some extent, the population are on board with that strategy. Even though they suffer as a consequence, they say that's what makes America, and they just do it. So this is further evidence. If you ever wanted to see evidence of the US response to stress, look at the Baker rigs and the Baker Hughes rig count.
Does it actually, though, back on, say, a stock like Wesfarmers, which has got coal exposure, does it actually act as some kind of a comfort that, to Mark's point, China's paying lip service, but actually the show goes on, dirty energy reigns supreme. That's the bottom line.
They've still got a lot of electricity to pump out on a daily basis. They've still got air conditioners. They've still got, heating and so on, and coal-fired power plants. While summer's shutting, there's still plenty of consumption out there. So, and I don't think that story is necessarily going to go away. The only alternative would be that'd be a massive ramp up as far as nuclear, and I think that's a long way off. So at the present, you've that solid push.
Mark, I heard a sigh there. Is that to say you disagree?
Well,
on nuclear?
I'm with Pete. You're not going to see nuclear being the one, and that's not it. I think that you'll see them limp along. I looked at some stuff today where they thought because of the slowdown in China, there might actually be some environmental benefits. and they might have actually peaked from a greenhouse gas perspective. And that might be something that will change some of the economic dynamics around how they engage with the US and what they'll look to do. So there might be a natural culling of those industries because of the way their economy is reshaping. So that would obviously be a positive. It's interesting how they couldn't cut it out when it's clearly, I've seen the photos. Some of their work behaviour would be frightening.
Well, I mean, then again, you flagged the transition before. We are talking a scale that no other country has had to embrace.
Exactly. You know, when you're looking at an industrial, third industrial revolution as far as what we've seen as far as consumption patterns and a changing world. And that's just happened over the last 10 to 15 years.
You get to a point where, frankly, China has every right to say to its rivals in the US, you know, go take a walk. Come down here and try running it and then understand it before you teach us how to suck eggs.
Exactly. And sure, we might be burning some coal-fired power plants, but put your mind back 40 years and they really didn't have any coal-fired power plants. There wasn't a lot of electricity there. I remember talking to, the professors that would fly in there and do some teaching in the late 90s, and they'd call it brownouts as far as the power going off for the best part of 8 or 9 hours at a time. So you're at Shanghai and then all of a sudden you're teaching in school and there's no power. So, and that's only 15 odd years ago. So the whole world is, China's come up the curve. I've been there quite a few times. You look at Beijing on a very, very bad day with air pollution, it's frightening. And all of those impacts are very, very mindful as far as health and so on. So,
again,
that's the reality of the matter.
Hong Kong on a very, very bad day.
Yeah, you can't see the other side.
Mark, is there a kind of a cautious optimism in the West on everything we've said? Do you take some comfort from that? There are some true believers who might be just clinging to the kind of China does it its way and will continue to do so story.
Oh, I think so. I mean, I'm very bullish on Australia. I think our performance has been extraordinary. I'm very bearish on Europe because I don't think it's got the capacity to change. I think the US is a beacon around. It will always be strong just because of the nature. And I think China's just learning where it sits. Does it sit closer to Europe or does it sit closer to the US? My inclination is that if they get the environment right and if they get the one-child policy, which is now not the one-child policy, but if they get the social contract right, then they'll lead a lot more towards the US. They are obviously a very competitive nation. They are looking to grow from a nationalistic perspective. So I think that one China view will be more aligned to the US capacity to grow and the desire to grow than the European model. Lack of, that energy that Europe lacks.
China has.
Is of great concern, and China has got great energy. So I think, I'd be positive on China over the medium to long term.
Chinese entrepreneurial zeal, there's no doubting that. I mean, they're workers. Go there and you see people, you see building and construction at 2 o'clock in the morning. So it's a different world. It's like India, it's like, the Bangladeshis, it's like Asia. They are engaged and they make things happen. You go to Europe and it's a different mindset. It's a 4.5-day week at best and very, very hard to be entrepreneurial there if you want to start a business. So that mindset, as far as go get them, has been very much copied from the States. And I think that that's probably going to be their strong competitive advantage.
And it's interesting that they have made a beeline to London for clearing on the yuan. It's basically become a magnet. And that really speaks to this pending Brexit vote. Why would you want to stay clinging on to something that's clearly so deficient? Break free.
Yeah, there's an argument internally as far as what political side, and then you've got the man on the street as far as whether they want to stay in it or whether they want to leave. And it seems to be a groundswell that's gaining momentum, and I feel as though that it may be a Brexit. But we spoke about this a year and a half ago, or a year ago, is what the Greek situation was, and they stayed in. So it could be just, liar's poker, and that may be it.
We haven't even talked Germany. Mark, Todd, to you, is that maybe the next domino that would go on a Brexit, and how would that basically undermine the whole project, the whole European project?
Well, clearly that would if something happened with Germany. I would say that I think so. Britain has no option. In my mind, it has no option but making a positive story about Europe, and it needs to engage with Europe and make it a positive outcome. I don't think it helps if you throw rocks at the glass house. And particularly, you know, I don't know that you can say that anyone is a good agent in this behaviour. Okay. And you have got real risks in these economies. You've got your you know, the disaster of terrorism. You've got the disaster of the asylum seekers. You've got the real problems around who's your financial centre. You've got lack of political unity. But I think you've got to make the best of it. You've got to actually work together. Otherwise, I don't think leaving the EU will help terrorism financial centre. I just don't see it being a benefit. I just think you need to then get in and say, how are we all going to work together? Who will work for the common good? That's a conversation that will have to take place over decades.
They had it over Greece, as we said earlier, and they concluded they couldn't have that conversation other than extend and pretend over something which, frankly, no one in their right minds, it says passes muster.
But
it buys time.
I'm with you, but I do want to know, do you think they thought they did the right thing by Greece in terms of the way they approached it? And I think that was it is a cycle in time where the GFC said, hang on, all the accounts have to be legitimate. And everyone went, well, hang on, we haven't been doing that since 1973. Yeah. You know, we've always been lying. This is smoke and mirrors. No. And that's an evolution on how you have to behave as an economy of people. And I just think it's more about how have you crafted that conversation so you're united? And I just don't know that they're doing that. And I can't see England saying we're standing alone will be better for the experience. I just don't get that.
Well, to be, though, in the basically in the thrall of Dr. No, a.k.a. Wolfgang Schäuble, in perpetuity, equally doesn't seem that attractive a prospect. Well,
and it's going to run, and you look at the other side as far as volatility into markets, that's going to feed it, and that's what markets want. If markets look at volatility, they want unknowns, and that plays into it. You've got, think of the storm we've got ahead of us over the next 6 to 9 months. Sure, we've got an election here, but you've got Brexit, you've got Yellen, you've got the possibility of Trump, or is it going to be Clinton in there? They're big game changers over a 9-month period. So what's it going to do? You're going to see wild swings in equity markets, and then you've got a commodity market. The world's not sure what way it's going. You could see crude at $25. They all play into a market, then currency. And very wild times.
You started the chat with copper. You have to conclude off all of that. It's going to be one sick patient.
Sick patient for at least 18 months.
Okay, and that does mark Todd play into BHP.
Does it, beg pardon?
It plays into BHP by default then.
Yeah, that makes the world of BHP harder. I mean, what that plays into is Telstra, the 4 majors, you know, all the people who just play locally here who say, you know, I'm over there in periphery, Wesfarmers. It just plays into those organisations that all the SMSFs are invested in. It's the people who play locally. That's who are not party to, can I win the European British argument? You know, it's a much simpler experience.
Or they look at funds and they see, right, I need to be in emerging markets for these reasons, X, Y and Z, and you see the capital outflow, and you look at overseas investor funds to be a part of that opportunity.
Okay, well, on that note, we can't change the world, but we get another take on it for you after this break. Stay with us. We're back, and that feature interview with Dr. Shane Oliver from AMP Capital Investors is ahead after this. Well, a reminder for you today, it was rates decision day. They took the decision, we're led to believe, in Tasmania. They were on one of their away months. 2 they hold every year. There's a set meeting slated in Melbourne. The second, really, it's open for variation. Last year it was Perth, where one of our guest hosts, Mark Todd, is finding himself today. And this year, a year on, they selected Tasmania, with all the other competing interests that you might find there on a autumnal afternoon. In the event, leaving the official cash rate on hold, a record low 2%. Everyone pretty much was in agreement that that would happen. All eyes, though, falling on the language and quite a key change around the Australian dollar, pulling that into its own standalone paragraph, acknowledging the statement that the currency has somewhat appreciated recently. That could complicate the transition away from a mining-based economy. Westpac's chief economist, Bill Evans, here saying the Reserve, though, did not take the opportunity, he maintains, to jawbone.
They haven't taken up the opportunity to try and talk it down, because if they had tried to talk it down, we recall 2014 when they started to try and talk it down in February 14 and nothing happened until we got the impression that they were prepared to use interest rates. So talking it down would have been a very important signal. That hasn't happened in the statement today.
The Reserve's next meeting falling the same day as the federal budget. That's May the 3rd. Remembering that itself was brought forward a week as the tussle to get votes through in the Senate only leads to the live possibility of a double dissolution. So the need to get a budget away ahead of all of that distraction. Really, Sun Super's chief economist Brian Parkey joined us earlier. Doesn't reckon the budget, though, would be any kind of barrier to the Reserve moving if they chose in May. Still, though, he's not calling out for any easing.
I don't think we'll see a rate move anyway, because I don't think the outlook is really going to change enough between now and then, certainly not in terms of the labour market or the inflation outlook to justify them changing rates. The trend unemployment rate is probably your best single guide, and as long as that continues to gradually trend lower, then you're not going to be talking about a Reserve Bank cutting rates. If that reverses, then all bets are off. Then the Reserve Bank, I think, comes back into play.
And as well, just to add another component to this discussion, a little earlier, outside the Reserve Bank Martin Place in Sydney CBD, I was joined by Shane Oliver, Chief Economist at AMP Capital Investors.
Well, I think it indicates that the Reserve Bank is becoming increasingly concerned. Last month they devote an itsy-bitsy sentence to the Australian dollar about it adjusting. Now they devote a whole paragraph to the Australian dollar, not only acknowledging that it's rising, but also indicating that could complicate the rebalancing of the economy that they've been working towards over the last 3 years now. So to me, that's quite significant. Even though the foreign exchange market actually saw the Aussie dollar rally on the news, I think that's a sort of a soft form of jawboning, saying that if the Aussie dollar doesn't start behaving, then they might act on their easing bias.
So they've linked it as well to commodities, which, if anything, the market, again, doesn't believe quite justifies this run-up. So if you've been tracking gains in iron ore and perhaps even crude, if they were to reverse, is it safe to assume the dollar follows it down just the way it went up in lockstep, and that might be actually a helpful development? We'll pull out of that just to bring you across and get some commentary, of course, to that breaking news you're seeing on screen. ASIC's put out its own statement confirming now civil penalty proceedings launched against Westpac for BBSW conduct, saying it's today commenced proceedings in the Federal Court in Melbourne against Westpac for unconscionable conduct and market manipulation over its involvement in setting the bank bill swap reference rate between 6th of April 2010, so these are historic claims now, and June the 6th of 2012, so effectively a two-year window. BBSW, the primary interest rate benchmark, as they identify, used in Australian financial markets, administered by AFMA, rather. That's the acronym for the Australian Financial Markets Association. They changed, though, this is where it gets a bit complicated, methodology back in 2013. So how you even calculate BBSW, some questions seem to, even at this point in this statement ASIC puts out, be under something of a cloud. The conduct that the proceedings relate to, they say, occurred before, though, that change in methodology. So the flagged changes occurred, but saying this predated that, alleging Westpac traded in a manner intended to create an artificial price for bank bills on 16 occasions between 6th of April 2010 and 6th of June 2012. ASIC alleging on those days Westpac had a large number of products priced or valued off BBSW traded in the bank bill market with the intention of moving it higher or lower, alleging Westpac sought to maximise its profit or minimise its loss to the detriment of those holding opposite positions. They want declarations now that Westpac contravened effectively the Corps Act, the Securities and Investments Commission Act, rather. But that's the forerunners to the Corps Act in any event. So that's just technical sections, and they're also seeking from the court pecuniary penalties. So going above and beyond in that respect to. You have to conclude, set an example here, pulling out Westpac, you only seek pecuniary penalties if you're effectively, correct me if I'm wrong, my knowledge of banking law procuring damages full stop. It doesn't have to be banking.
Exactly.
It's to really send a shot across a sector's bows on conduct, and also an order requiring Westpac implement a compliance program. Let's get the panel with me. Pete McGuire from XE.com, and to you, Mark Todd. Maybe, I mean, and in fairness, you from the NAB yourself, we are talking a sector here in focus. NAB's been pulled out on this. What's your initial reaction?
I'm just trying to read I'm actually reading it now, and look, it is such a really hard thing for everyone to understand. So I mean, clearly, Carson and I want to be at NAB tomorrow, so I need to be mindful of all that. I think that the conduct risk around behaviour is something that is, to some extent, needs to be isolated in its own right. So what people write and say and behave, you need to be held to the highest standards. You need to be, NAB wants to be the most ethical bank. It wants to have the best reputation. They're great standards to try and hold yourself to. So that's a really important thing to do. The machinations of how the bank bill market worked in those days, and in those days I ran a company called Tulloch Prebon, so that was part of the process that people went and put bids in. That is much harder for everyone to get their head around what was going on in those engagements. So all I can say is that you'd like to think that people were trying to do the right thing at all times, and that they continue to do the right thing. I think I've seen some of these chat rooms. They're an embarrassment. I just don't think people should be conducting themselves in that way. And I think the courts will make a decision on what was right and within the context of what they're allowed to do and what's legal and what's all that. I think it needs to separate the conduct where you just need to behave like a good corporate citizen. You need to try and do the right thing by your customers at all times. I think that's a very honourable thing to try and do. If that's the goal of ASIC, completely support it. I'm looking at it here and I just can't see what they said they actually did. They tried to make to the benefit of the bank. Look, I just don't have enough information to be able to offer any comments on what they did.
Early on, it's alleged, they say, ASIC, that Westpac traded in a manner intended on 16 occasions to create an artificial price for bank bills during a certain window of time.
26 months.
There's also a LIBOR equivalent and a world away, right?
Yeah.
Let's put it into context.
It's a world away from LIBOR. LIBOR is where people said, this is the rate I think we would have lent at. This is an engagement around this is what people have to do. They have to actually exchange those rates and then they put up into BBSW. So they traded and then they announced to AFMA what they thought the rates would have been on the basis of what they traded. Now, you knock out the top and the bottom, you come out with some numbers. I just don't have enough information to see what they did. But if they did the wrong thing, they'll suffer.
We're going to take a break. I think it also speaks in part to risk management, to culture, which has been under discussion. Let's talk that when we come back. Who does what, when, and what they call themselves and what they do in practice, and what they can do, what's realistic, and what does ultimately occur notwithstanding. Back after this. Welcome back, and we continue with breaking news for you. It is an ASIC investigation in the last, 20-odd minutes launched, and it's on banks, but specifically Westpac singled out on BBSW conduct. The period of time ASIC alleges this occurred 6th of April 2010 through to 6th of June of 2012. 16 occasions ASIC is alleging where the bank Westpac traded in a manner intended to create an artificial price for bank bills. And that, they say, they had a large number of products priced or valued at BBSW, traded in the bank bill market with the intention of moving the BBSW higher or lower. Now, Westpac's come out with the statement itself to the ASX, so we need to just talk to that, the headline on it. They will defend proceedings vigorously, they say, and go on to say by ASIC naming them in connection with ASIC's ongoing industry-wide investigation to past practices. That alleged conduct, they've said, occurred between April 2010
and 26 months.
Yeah. It's interesting because that's effectively just restating what ASIC itself said. Westpac's pointing out, Mark Todd, quote, that ASIC has not suggested it's got any concerns with Westpac's current practices, and there are no allegations of collusion with any other entity. Now, there's also a quote. Chief Financial Officer Peter King goes on to say Westpac takes conduct very seriously, has fully cooperated with ASIC in its investigation by indeed providing over 12 million Westpac documents for review. That's an awful lot of paperwork already, saying we reject the allegations made by ASIC, do not believe Westpac or any employee has acted unlawfully in relation to the instances detailed. Are you surprised, I suppose, at that rush to reject, or is that the inevitable closing the gate and hoping horses haven't bolted? Pete McGuire.
Well, first off, it was over a 26-month window. Secondly, it was 16 occasions. Thirdly, it's 4 to 6 years ago. Fourth, the same management team still there. There'd have to be, of those 12 million or 11 million documents, they'd have to have a lot of review. They would have done their research. This has been an ongoing, I would say, you would have had a red flag on this probably 3 to 6 months ago. They've had teams of compliance people look through all of this data, and they'd either come to the conclusion, no, there was no collusion, there was nothing that we were doing to really corner a market or change behaviour, and the hand on heart to say, well, we believe we haven't done anything wrong.
This, again, and to the CFO, Peter King's additional comment, we disagree, quote, with ASIC's interpretation of communication between employees and their assessment of trading activity. Mark Todd, they then end by saying, now that it's going to court, we won't be commenting further at this time. Is this ultimately just a dispute around practices that a court, frankly, is not even equipped to make? It'll be a case of expert witnesses. Where do you have a meeting of minds, ultimately? How can you?
Yeah, look, it's a very, like I said, it's a very complex issue, and I think it needs to be separated around, and Westpac seems to be trying to do that around, you know, the collusion, the stories of that. Look, it is a very hard subject, and I think the court will, you know, can the court understand it? Of course it can. Will the court make a decision? Of course it will. And I think it's probably best to allow those two companies to make their cases. And I think that's where the trial by media, no disrespect to anyone in the media, they need to be able to take the time to say, here's 12 million documents. I mean, that's an awful lot of documents. Yeah. Here's what you've got out of that 12 million documents. Okay, let's cut to the rub of that and work out, did anyone do anything wrong? And let the court make the decision. I think it gets very passionate because it's been linked to the LIBOR story, and that was clearly so bad. I mean, I'm not saying this isn't bad. I'm just saying we're in a jurisdiction that is regulated. Allow the regulators to go about.
All the same,
we'll do a good job. The court, and then. But the key is this conduct risk. It's really important. It is massively important, Carson. You can't go around carrying on like a bad person.
So these shares that are traded in New York, they are going online in London shortly. What's your instinct tell you, Mark Todd, occurs at that point? And beyond that, with a short selling interest already on Australian banks, what does that do to the nature and the step up potentially in that story, even into tomorrow?
No, I don't think that's... I mean, everyone's aware of these investigations taking place. I don't think that's going to change the dynamics of where you think valuation in Westpac. This is from 2010, and they've made the point that they think this is where they are. Even on
pecuniary damages that ASIC talks about today, that very spectre of pecuniary damages.
Look, I think that's it's a long way from a court case. I mean, it's a long way from that taking place. I think that is... It'll have to play out over the next year or so. I think that will be manageable.
So you don't think in this febrile, volatile environment, investors are minded to sell first and ask those detailed questions later?
If they sell on the basis of that, on a court case that will take years to come to fruition, you probably think that you should be buying. That doesn't sound like a very professional approach.
And a final thought to you, Pete McGuire. This is a comment in the statement from Westpac from the CFO, not the CEO, not the Chief Risk Officer. Do you find that in itself... we had Common Shaw, we had Ian Narev fronting, even though it wasn't his division. It wasn't a CFO palm-off. No. Why go to the CFO on this, not the CEO?
Well, it's a hard one to speculate. I don't know. I mean, when I look at that, that doesn't... A CFO is certainly in charge and he reports naturally to the CEO, but more importantly to the board. They're probably across that C-suite. You've got all of your different, you may have compliance, I'm not sure as far as an organisational chart. If you look at who reports to the CFO, it could be risk, it could be compliance, it could be all of these components that make up that division, and he's coming out and saying, right, this is, and the CEO's given him I suppose the path to say, take it to the market and explain the situation. That doesn't surprise me.
Carson, Carson, we don't even know where the CEO is. I mean, this has come out. They've announced it. ASIC came out, what, an hour ago now? Yeah. Westpac's come out 10 minutes later. I am assuming it will be more...
CEO could be on a plane to the US, who knows?
You just never know. Still, within global communications, reaching them is never...
Sure, but he could be on a plane quite easily. You could be on a plane to Asia on an 8 or 9 hour leg, and then all of a sudden you can't say anything, and that's why the CFO jumps in.
We are in the realm of some speculation, admittedly leading you down that pathway. We'll take a break. We'll return with the final segment where we'll take you to London Live. Michael Hewson, our next guest from CMC. Stick around. Welcome back into the programme. Of course, Europe looking for direction as it does pretty much every session, but really what next catalyst could push things up into clean air or perhaps bring things down into further desultory territory. Michael Hewson from CMC Markets live in London for you to end the show on. Michael, welcome into the programme. Mood-wise, where are we at with risk? We've had some pretty bearish calls out even from Codelco on copper. If that's any kind of barometer, it suggests no continent's looking immune right now. The last thing you needed, frankly, if sentiment was hanging by a thread.
Yeah, absolutely. And I think to cap it all off, we've had Christine Lagarde talking on the wires this morning about warning about the growth outlook and the potential. I think she could actually be softening up the market for another growth downgrade when the IMF publishes its latest forecast later this week. More importantly, I think the decline in risk appetite that we've seen over the course of, say, for example, the past couple of days, I think is also being reflected in commodity prices. Iron ore prices have come off their highs in March, as have copper prices, have crude oil prices. Fundamentally, I don't think an awful lot has changed. European markets have been trading in a fairly broad range over the course of the past month or so, but they've had several attempts to push higher. They failed, and I think we're having another look at the downside. And I think what is more concerning is the fact that we're seeing the yen strengthen quite significantly early this morning, a 17-month high, and this is pretty much a month after the Bank of Japan went into negative rates. And I think when a currency shrugs off a interest rate reduction of that magnitude, then I think you're really in trouble. And certainly the Central Bank of Japan, the Bank of Japan, is in trouble right now.
And you might add to that list Mario Draghi's woes as the euro continues to find support. Again, counterintuitively in so many respects. Does it, to your mind, come down to current account balances, surpluses rather? And that's perhaps one key factor.
I think it's certainly one key factor, but I also think there's been a slight change in tone since the G20 meeting in China a few weeks ago. I think central bank policy has become slightly more coordinated. We've had a softening of tone from the Federal Reserve, and Mr. Draghi is no longer targeting the exchange rate. He is now targeting the credit channel to try and get loan growth going and lending to businesses going. And I think the caution, that we could see coming out of the Federal Reserve, certainly Janet Yellen slapping the hawks down last week, I think speaks to a wider concern about international factors. But I also think that potentially the US labour market may not be as strong as maybe we think that it is. Certainly the headline payrolls growth has been fairly good, but if you look at the Federal Reserve Labour Market Conditions Index, which tends to fly under the radar a little bit, it is a good barometer of the health of the US labour market. that has gone into negative territory for 3 months in a row. That's the worst run of declines since mid-2009, and maybe that particular indicator is disguising some concerns about the resilience or otherwise of the US labour market, and maybe that's why Yellen has softened her tone.
Exactly right, Michael. I was just going to say that you beat me to the punch. There's no doubt that that number would be very, very aware as far as Yellen's concerns, and we're seeing her reaction primarily to that number to say, look, the handbrake's on, we're not doing anything else. And I think that there's going to be all of that push forward. We was going to say there's going to be another rate rise, another rate rise. I think the wind's out of that sail.
Michael, Mark Todd here from the NAB.
Yeah.
Sorry to butt in. I just wanted to add on to that, the idea that there's no rate rise. But what about Lagarde? If Lagarde comes out and says, OK, things are softer, and she spoke about China being a risk to world economies, do you think the market will discount her because generally that's what the IMF have been saying for the last, I don't know, 8 years?
Yeah, I mean, I think when you look at the IMF, I think you have to look at it in the context of the rearview mirror of your car. I don't think she's really telling us anything that we don't already know. I think the wider concern here is that despite extraordinary central bank policy that we've seen over the past year, you know, the economic outlook doesn't appear to be improving that substantially, and I think that is a significant concern. And certainly I think, you know, when you actually look at the euro and you look at the dollar and you look at the yen and you look at the Swiss franc and you hear all this jawboning by central banks, and growth still remains very, very weak, and that has to be a worry.
It's absolutely when you bring it all home, and by contrast, our Reserve Bank says over the period ahead, Michael, new information should allow us as a board to assess the outlook for inflation and whether the improvement in labour market conditions evident last year is continuing. It all looks so sedate and so kind of just sanguine on it, doesn't it? And like as you pointed out, the real kind of simmering, seething worry now emerging maybe in the US and the great importance that might have globally.
Well, I think there's a wider concern with respect to the US. There's a US presidential campaign taking place, and you've got Donald Trump on the one hand and you've got Hillary Clinton on the other. And I think, you know, the prospect of a very fractious campaign could also feed into a slightly weaker US economy. When you drop that into an already, I think, weak global outlook, I think 2016 is certainly going to continue to essentially be the same that it has been over the course of the last 3 or 4 months. It's going to be very choppy, and I think it's going to make upside progress very, very difficult to sustain in the absence of any meaningful reforms, certainly here in Europe, and any meaningful growth. Certainly some of the data has been improving, but there are a whole host of factors that could actually derail that. And certainly the Brussels attacks, the terrorist attacks in Brussels, are one symptom of that concern that I have about the European economy.
Okay, and it feeds into Brexit supporters and their idea of putting up walls. We'll do an update on Brexit perhaps next time we talk, Michael. For now, we must leave, but thank you so much. Have a good day's trade. Michael Hewson from CMC Markets, they're live in London. I want to thank the panel as well. From the West, Mark Todd from the NAB today is over there with that insight. Thank you, Mark, so much. To you, Pete McGuire from XE.com as well. Thank you, Carson, as always, for great input into the show. We got through a lot, including that breaking developing news on Westpac, which we'll continue to monitor. It'll be on Final Count with Pete and I. More of that after this break. Stay with us.